Hello and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
And I'm Valdana Hayek, a cross-asset reporter with Bloomberg.
And this week on the show, well, stocks are all over the map again, with benchmark indexes moving 1%, 2%, 3% or more each day between their highs and lows. And Treasury yields continue to creep higher. Most are at the highest in more than 15 years. Meanwhile, just about everyone is convinced that at least a mild recession is on the horizon. So, what on earth are you supposed to do with your money at a time like this? We'll get into it with the chief market strategist of a major investment company. But first, Vildana, just get it out of your system. I know what you want to do with your money. You want to bet on the Buffalo Bills at this
Forever.
point.
Yeah.
Or at least gloat about the Buffalo Bills. So get it out of your system. Go ahead.
I'm not going to gloat. I'm a very superstitious person, so I need good karma. So no gloating on my end. However, Josh Allen is a superhuman. Did you watch the game?
He is pretty good. Yeah, I watch most of it. I still.
Did you see him jump over that man? He jumped over a man.
Yes.
Who does that? He jumped like 8 feet into the air.
Not me. I can barely jump over a small child. How a woman who grew up where you grew up is not an Eagles fan, or at least a Giants or Jets fan. I would even allow Giants or Jets.
No.
Bite your tongue.
Not the Giants. No.
Yeah.
No, the Eagles. I'm with you on the Eagles, definitely. Right. And I'm rooting for them. I'm happy that they're doing well. But the Bills are so fun to watch.
Was your husband lured you into the Bills nation?
Yeah, he's from Buffalo. Yeah, he's from Buffalo.
Well, you're a good wife. My wife is an Eagles fan too. There's no way I could have lured her away from the Eagles if I
have an Eagles jersey. Of all the games I've been to in my life, the majority of them were Eagles games.
All right.
There you go. I'll give you that.
How many folding tables are left in your apartment right now?
Oh, none. They've all been broken through.
They've all been broken?
Yeah, by Bills fans. Yeah. Bills fans who set themselves on fire and then jump through tables.
As one does, yes.
We have a guest here with us. We should bring her in. Kristina Hooper, Chief Global Market Strategist at Invesco. Thank you so much for joining us.
Thank you for having me.
Kristina might be a Jets or a Giants fan, but we'll leave that for another conversation.
All right, spill the beans, Kristina. Who's your team?
The Knicks.
The Knicks?
Yes. The Knicks?
It's like perpetually being in the seventh circle of hell.
Oh, that's good.
I didn't want to say anything.
But you definitely develop an important skill in terms of patience and persistence and constant optimism. Or else you would just lose your mind.
That's a buy and hold franchise, I guess.
For sure.
But Kristina, markets have been very interesting the last couple of days. And I was hoping to just start out with you talking about what it's been like to be a part of this market, to be watching this market and everything that we've seen going on, where we have these, stretches of days where it's up 2%, down 2%, up 2%, down 3%, up 3%. It's just very volatile.
It's incredibly volatile. And yet, in a way, it makes sense given that we have this one key driver of markets this year, and it's been the Fed. And really, the just dramatically shifting expectations around what the Fed is going to do. The Fed has even surprised itself. If we look at the dot plot from December of 2021, they thought they'd be at 90 basis points at the end of 2022. Now they think as of the September dot plot, they'll be at 440 basis points. That to me is monetary policy whiplash. And those kinds of surprises are why we see the volatility, not just in stocks, but in bonds.
Kristina, I know a lot of people were hoping that at least we get some diversion from the Fed focus during earnings season. And it seemed like, the first couple of early reporters really sort of reignited some of the bullish instincts in the market. And that's why we saw some really big gains. What are you looking out for in earnings season? What have you learned so far? Is there enough meat on the bone in earnings to maybe overpower that Fed fixation in the market?
Great question. And great question. So let me start at the beginning. What I've learned so far, first of all, it has been, fairly focused on financials thus far. What we've learned is that consumers and businesses are in pretty good shape, right? We've heard that from multiple bank CEOs is that the consumer's in good shape, businesses are in good shape, and that certainly is a positive in terms of being able to weather economic headwinds. But it is a negative in that the Fed doesn't seem to have cooled demand very much. We also know financial conditions are tightening. We're hearing that. We're seeing it in the data banks are providing in terms of, the average FICO score for people they're giving mortgages to. So fundamentals are solid, but clearly lenders are becoming increasingly discerning, which is what the Fed wants to see. And we've also heard from a few airlines, one major airline saying that the summer was very strong, and they don't think that the demand for travel, that thirst, has been quenched yet. So as I process the earnings reports, I'm beyond just the earnings results, which have been relatively positive. My takeaways are that the Fed hasn't necessarily achieved what it wants to yet, and so we could be in store for a fair number more rate hikes given this environment.
Kristina, can I ask you, we used to think about the earnings season as a stretch of time that will give us clarity on things that are going on. Can we make that same case this time around, or is it so much that there's so much uncertainty with the Fed, the macro outlook, et cetera, that the earnings season really even can't be giving us as much clarity as it might have in the past?
I think that's true to a certain extent. I mean, let's think about it. Earnings season in general is backward looking. What we can glean about the future comes from what is shared on the earnings calls to the extent that management teams are willing to provide an outlook. And I think it is far less clear because they don't know where the Fed funds rate is going to go from here. And they really don't know how much damage has been done thus far because it takes some time for that to actually make its way into the Main Street economy and show up in data and certainly show up in their results. So I think the question remains, when is that other shoe going to drop vis-a-vis earnings? Now, for some industries, it could very well drop this quarter, but for others, it might not be this quarter. It might be next or beyond.
So what do you think we need to see to get either not necessarily even a full pivot from the Fed? I think, a lot of people would be happy with just sort of go back to a 50 or 25 basis point rate hike. But what really, where do you need to see that inflation start to cool off? I'm guessing is it the shelter and rent costs? Is that the main issue that's still front and center for them, do you think?
Well, I think that's certainly one key issue for them. But beyond that, I mean, what we're seeing is a labor market that remains very tight. And so that's showing up on the services side of the economy. That's showing up in the wage growth we've seen thus far. So, the Fed, I think, is looking at the economy through a Phillips curve lens. And it believes it needs to achieve a certain level of unemployment in order to see inflation moderate. I would argue that doesn't have to be the case, though, given this unique market environment where we have just such a high level of job openings, even after the last JOLTS report. We still have more job openings than there are people to fill them. And so if we were to see a major slashing of job openings, that reduces labor mobility. And so that goal of moderating wage growth could potentially be achieved without having very significant layoffs, without having a very substantial increase in unemployment.
So can you talk about what you foresee from the Fed in the coming months? Because we had the Fed minutes come out recently. It was just last week. And then also we had a report from Bloomberg where one of my colleagues actually looked through the minutes and found, I guess it was some detail that others hadn't noticed, saying that Fed officials were worried that we were coming off of an extremely hot economy, and that means that potentially they will be tightening more aggressively or for longer than previously thought. So what are you expecting from the Fed?
Well, certainly the most recent FOMC minutes were not dovish by any stretch of the imagination. I think people anchored to that statement about a few participants worrying that they were moving too quickly. They'd need to calibrate because of the delayed impact on the economy. But in general, I think what the Fed is telling us is that inflation is not just job number one, it's job number one, number two, number three. And that dual mandate, really, that other part of the dual mandate is really being put on the back burner, on the way back burner, as it focuses on inflation. So that says to me that the Fed will definitely hike rates 75 basis points in November. And I think 75 basis points is on the table for December as well. I think that's a very real likelihood, especially given some of the recent statements we've gotten arguing that the Fed wants to front load rate hikes like the Bank of Canada. Well, I thought we were like in the sixth or seventh inning when it comes to rate hikes. So to hear they're still talking about front loading causes a little concern and does raise questions about when this finally comes to an end or even just eases somewhat.
Kristina, you mentioned the notion of the Fed tightening until it breaks something. And it seems like at the moment it's pretty close to a consensus that the U.S. is going to slide into at least a shallow recession next year. But I also look at the market, S&P 500 down as much as 25 and change percent from its high. NASDAQ index is down even more in the 30s of percentages. With everybody bracing for this recession, I mean, are we in one of these crazy scenarios where the market is so far ahead of the economy that it's mostly all been priced in or almost all priced in? And if we do get that slowdown, that we'll see that sort of contrarian instinct kick in, and we'll get a rally in the equity market. Is the worst priced in, do you think?
I don't think it's all priced in, but I do think some is priced in. I mean, what we've seen this year is a multiple contraction driven by the rise in the 10-year yield. But has earnings disappointment been fully priced in? Probably not, because we don't know the extent of the impact to earnings, because we don't know the path of rate hikes from here. So I think that there's that level of uncertainties that makes it hard to price in. And to me, I think there's the potential for another leg down. Are we going to go down as much as we have thus far? No, I highly doubt that. But I do think we could see another 5 to 7% drop to before we get to the point where it's priced in and where we're ready to perhaps begin a bull market that is anticipating an economic recovery.
And why has it been so difficult to price things into the market this year? Is it just because we have this discrepancy between what's going on with the labor market and what's happening with inflation and the Fed?
Yeah, in a word, it's 75 is the new 25. When you're raising rates in 75 basis point increments, and you're not giving any time for it to process through and make its way through into the data, you're playing a dangerous game. And the more you're doing it, the more likelihood you create of having a recession and a significant recession. So I think that is what's behind this. I think there's a lot of uncertainty, and as you point out, there's uncertainty around inflation and where that goes from here. It's been stubbornly high.
Kristina, when you say 75 is the new 25, be careful. You're setting Vildana up for a joke about my age. I can't.
I wasn't going to say anything.
Yeah. You're right. Of course. Kristina, Invesco's a huge company, famous for a lot of things, a lot of different investment strategies. But I think if you do like a name association with a lot of people, they'll go right to the QQQ, the NASDAQ 100 ETF. I think, a lot of people that I've talked to, I've always gotten the sense that once we got through the other side of the pandemic, when interest rates normalize, growth normalizes, and life becomes more like it was pre-pandemic, that we'd once again see that instinct to buy big growth tech, really the main companies in the QQQ ETF. Is that still a realistic assumption or anticipation? I mean, are we going to revert back to where the big tech stocks are the stars of the show, or are we just in a whole new paradigm now for the time being or for the foreseeable future?
Well, I certainly think that it's likely we revert back to tech performing better than the cyclical side of the stock market in the near term. I mean, tech has been beaten down, as it traditionally has been, by rising rates. But once we get through a period of time and adjustment, usually tech then starts to perform significantly better. It's part of what investors now view as the defensive part of the stock market. And so I think there's certainly going to be a real interest that doesn't go away. Also, just for the longer term, tech is a big part of innovation. It's a big driver of where the economy goes from here. So I think it's going to continue to be a significant portion of most investors' portfolios.
And as Mike mentioned, you guys have this huge suite of ETF products, and I'm wondering if you are also tracking what the retail investor is doing, because retail investors, they tend to favor ETFs a lot. But what is the retail cohort doing at the moment? Because I've seen some notes recently and some interesting research that's showing that they're selling into any rally really recently, whereas earlier in the year maybe they were buying the dip because they had been sort of conditioned to do that over the last 2 years. So how important, or what role is the retail investor playing in this market?
Well, if we were to look at the AAII sentiment surveys, that certainly shows a very bearish level of sentiment among retail investors. But I think that's the kind of thing you need to help form a market bottom. It can be a pretty temporary phenomenon. And unfortunately, I think some retail investors hurt themselves by doing that. In fact, I'd argue perhaps the biggest mistake made in the global financial crisis were those investors, and it wasn't just retail, it was also institutional, that cashed out at or near the bottom and then locked in their losses and weren't able to participate in a recovery. So certainly there's some of that going on. But hopefully more investors are thinking long term. Hopefully, a lot of the education that we've done has had an impact in terms of having, a well-diversified portfolio, both across and within the three major asset classes, and also thinking long term. Because, as much as this is a difficult market environment and it's painful to read the headlines and look at the statements, it is still very much a temporary market environment. And for many that have 10 and 20-year time horizons, they hurt themselves by becoming panicked or letting emotions take over right now. And
Kristina, I know you have a global focus, so I'm going to land the plane next in Beijing, China. The Party Congress is going on this week. I don't think any major surprises, but it's become pretty clear that their COVID-0 policies are not going anywhere anytime soon, or at least won't be relaxed anytime soon. How are you thinking about China and its place in global markets these days? On the one hand, COVID-0 is sort of restraining growth there and possibly still snarling supply chains to some degree. But on the other hand, that's at least one source of the world where it's not necessarily an inflationary situation. I mean, maybe it is with the supply chains, but help us sort out how to think about China, where it goes from here, and sort of what the dynamics with the rest of the global markets will be.
Well, actually, not differently than what we saw in the global financial crisis. China is in a very different place than Western developed economies, which makes a wonderful case for diversification of portfolios, right? What we're seeing in China is a central bank that has actually eased monetary policy this year as opposed to tightening dramatically. We're seeing some fiscal stimulus that is significant. And so China's in a very different place than Western economies. So yes, COVID lockdowns could potentially be a headwind depending upon what happens in terms of future waves of COVID. But for the most part, China is ahead in terms of when it's likely to begin recovering. And in fact, I think we're seeing signs of recovery now. And that's why if you look at, for example, the IMF's projections that they put out last week in terms of growth expectations for 2023, for a lot of major economies, they anticipate growth to be lower next year than this year. That's not the case for China. Their expectation is significantly higher growth next year. I think that makes a lot of sense, just given the positives that are going on in the Chinese economy.
Can you talk more about what your view is on the possibility of us seeing a global recession? I think you had asked in one of your recent notes if a global recession is coming.
Well, it is very, very possible, just given that we have so many central banks raising rates all at the same time. In fact, we heard from the World Bank last month and issuing a very stark warning about how this is the first time in 5 decades we've seen this level of synchronicity in terms of tightening. And you don't have to play that police song in the background while I talk about this, but it is. It does increase the odds of a global recession. So we have to be vigilant about it. At this point, I think that there is still the potential for us to avoid that if central banks were to pivot soon. We just don't know if they're going to pivot soon. That is the big question on everyone's mind right now. But every day that goes by that we continue to be as hawkish as we see the kind of tightening we see, I think it increases the odds of a global recession next year.
Well, I applaud your taste in music. Now I've got Police in my head. I'm gonna have to go do a deep dive on the Synchronicity album later. Well, boil it down to us, Kristina, given everything we've talked about, what's the Hooper sort of recommended portfolio look like these days for sort of your average investor with a longer time horizon?
Well, it doesn't look that different, and it shouldn't look that different than the prescribed portfolio, the Hooper portfolio from 2019 or 2016, or quite frankly, 2010. And again, of course, it depends upon the time horizon for an individual investor, but a good rule of thumb is, a 55, 30, 15 type of portfolio where you have significant exposure to equities, and not just within the U.S., global equities and some dividend-paying equities, and a very diversified fixed income portfolio. Tactically, I might overemphasize investment grade and government right now, and then of course alts, REITs in there, infrastructure,
crypto.
Well, that's a great question. What I encourage is I say, you all have to do your homework on crypto. And I've told my kids this as well as, when I talk to investors. I know there's a lot of interest in it. There are a lot of differences among the different cryptocurrencies. Some might work for some investors' portfolios, but others might do enough research and say this isn't for me. But I think certainly be open to it and do enough research to know whether or not it fits with your risk-reward profile.
Do your homework. Blech. Phil Donner, you probably love doing homework, didn't you?
I love doing homework, yeah.
Yeah, I know it. I do.
Yeah, I'm taking French classes now, and at the end, when she doesn't assign homework, I'm like, do you have extra stuff we can possibly be doing?
Oh, were you a teacher's pet too?
Yes. I want to learn. Hello.
Well, all right, here's a little bit of a curveball addition to that question, Kristina. If I'm theoretically an investor who's sitting all in cash right now, enjoying these juicy money market yields that are finally, something that doesn't round to zero, does that advice still stand?
Well, what I would say is you don't want to go all in. You want a dollar cost average back in. But starting now makes a lot of sense. I mean, we've already seen a very, very significant adjustment in markets. I mean, fixed income levels, fixed income yield levels are pretty attractive right now. So that's not to say we aren't going to see more volatility. It's not to say that we might not see a leg down for the stock market, as I said, as rates go up. But we can never, as humans, precisely pinpoint when to enter the market. That's just very, very hard to do. So I think dollar cost averaging in makes a lot of sense in this environment where we've certainly seen significant losses this year and valuations are more attractive.
Well, Kristina Hooper, Chief Global Market Strategist at Invesco, we really appreciate it. If you have some homework, you can give Valdana maybe a worksheet or
would be good.
An essay assignment. I don't know.
A book. Do you want to start a book club?
I actually am much more interested in a movie club. I find it's just too much of a commitment to read, but I can easily watch a movie and then talk to you about it.
I just don't want Mike to be part of this club.
Valdana will read the book and you can watch the movie. I think that a hybrid.
It'll just be
club.
us.
Like breakfast at Tiffany's in that famous Seinfeld episode.
That's great. But we cannot let you leave quite just yet because we have a tradition on this show. Some may call it a gimmick. I prefer tradition, where no guest is allowed to leave before they share the craziest thing they've seen in markets this week. You start us off, Valdana.
Okay, mine is Halloween, fall, pumpkin, Thanksgiving-ish related, I suppose.
Really?
It is, but I really wanted to use this one just so I can take the opportunity to say that all the reporters on the Cross Asset team are getting together to carve pumpkins. But I didn't invite you, so I'm not extending the invite.
That's how it tends to go.
You're not invited. So anyway,
it's so cold.
So pumpkin spice foods cost 160% more than regular versions of things. Did you see this story?
Oh.
This is crazy. They're calling it, I saw this on CBS News. They're calling it the pumpkin spice tax. So it's in everything. Lattes, croissants, hummus, which by the way, pumpkin hummus, pumpkin spice hummus doesn't sound good. Dog treats, etc., etc. So basically just if anybody if any one of these companies has a pumpkin spiced version of a product, they can just upcharge you for it. And we all love pumpkin spice so much, we just go and pay it.
Are there like pumpkin supply chain issues, or is it just
no? I think it's
taking advantage.
Yeah. I mean, a pumpkin spice latte at Starbucks, I'm pretty sure is like $36 right now.
Yeah, and it tastes 160% worse than the regular one.
Yes,
I don't get this at all.
Oh, I like that stuff, but yeah, I'll go with
Really?
I'll support you here. Yeah, it can be good and bad.
Yeah.
Yeah.
I don't know. I'm not a big pumpkin guy.
I like pumpkins.
I love carving them.
This is why you're not invited. You're not invited.
I love to carve them though, and I'm so hurt that I cannot join you carving pumpkins. Kristina, how about you? What's the craziest thing you've seen? And you'll invite me pumpkin carving, I assume.
I don't carve pumpkins. So just so you know, you can talk to my kids. They'll tell you I am the worst mother ever. I do the bare minimum, and that includes never having carved pumpkins with them. So my apologies to my kids. I'm so sorry.
So no pumpkin carving for you this year.
No pumpkin carving. We can watch a movie about pumpkin carving if you want to, though.
I'm just out of luck. Kristina's all about the movies. I appreciate that.
Again, there's very little commitment with a movie. Very passive. You can even do your work while you're watching it, They need
to make a movie about the Knicks for you. That would, a Spike Lee movie about the Knicks. That would.
Actually, I'll give you a great Halloween movie that my son and I watched last week. What We Do in the Shadows. One of the funniest movies I've ever seen. Vampires having to live an ordinary life flatting in New Zealand. Not the TV show,
I've
the
seen
movie.
The TV show.
This is much funnier, the movie. Okay, so but I was actually very serious. Valdana had such a light, nice topic.
Just because I wanted to bring up the pumpkin carving.
I love it. Well, I I just focused on inflation expectations because it's a head scratcher. Longer term inflation expectations over the last few months have gone down. It's been nice to see that movement down. And then within the last week and a half, we saw an uptick in both the Michigan survey of longer term inflation expectations as well as the New York Fed. If that trend were to continue, that would be concerning. It is a surprise, just given that we're already starting to see the air taken out of the sails of the economy. But that is not how consumers see it right now. And 5 years ahead, 3 years ahead, the measure has gone up since the previous reading.
Are those the two best expectation readings, do you think, to keep an eye on? I think it's sort of, I don't know if it surprised people, but it certainly, many people noted it when it was, I don't know if it was Powell or someone else on the Fed really started talking about the Michigan survey.
Yeah. That was actually what tipped him over the edge. That and the CPI print. If you remember back in June, they were messaging 50 basis points, and then they got a hot CPI and a hot inflation expectations from Michigan. And within a few days, they had the FOMC meeting and they decided for 75 basis points instead of 50. So you're absolutely right. They pay attention to it. I think consumer surveys are far more important to them than market-based measures of inflation expectations.
Yeah. Well, as a Big Ten fan, I think they're giving way too much credit to University of Michigan. That's all I'm going to say about that. Tell me what the Michigan State inflation expectations are. Anyway, that's neither here nor there.
That's a good markets joke.
Really?
Yeah.
You're actually giving me credit for that one?
Yeah, we should tweet it.
I'll let you tweet that one.
Okay.
Question for both of you. How many iPhones do you think the two of you have each owned in your lifetimes?
I've probably had 3 or 4. Mine still has the little push button. I go a very long time before I get a new one.
Are you serious?
Yeah.
It's still got the push button?
Yes.
Wow.
Which number is that? What iPhone?
7 or 8 or something. Something.
Really?
Yeah, it's doubled basically. The numbers have doubled since the last time I got one. It's like on 14 now. Yeah.
How about you,
7.
Kristina? Including kids and family, how many do you think you've gone through?
Oh, in our family, I have 3 kids and a husband. So
yeah,
I mean,
I'm in the same boat.
So in total, we've probably owned, especially my daughter. I mean, she dropped. It's an embarrassing story, but she was making my son take photographs of her. And she was telling him to get closer. She was in her swimsuit, and he dropped the phone in the pool. So that was one right there. And by the way, you have to race to get to that dryer to try to dry it out. And it still doesn't work.
I'm familiar. You put it in the rice bowl.
God. We tried everything. So I want to say like 22, 23.
Wow.
Yeah. I'm up there too. I was going to get, with 3 kids, probably 15 to 20 at least anyway.
That's nuts.
Yeah. But no one cares for them. If you're paying for it, you care for it a lot more than when you're a kid and your parent cares for it. I've got mine in like an OtterBox case, like nothing's ever happened to it. They all walk around with cracked screens. They couldn't care less,
Yep. Well, here's a crazy story for you. The iPhone 1. Did you ever any iPhone 1s in your house by any chance?
No. But I know what you're going to say. It just auctioned for a lot of money or something, and but it was completely wrapped in its package and untouched.
All right. Spoiler, a little bit of a spoiler alert.
I'm sorry. I apologize. That was bad. I'm so sorry.
You ruined it.
I don't know what came over me.
So I think we know who's going to win the Price is Precise this week because yes, a buyer purchased the first edition of the iPhone. Sold by LCG Auctions. As you're right, it was in its case, unopened 2007 iPhone. So step up. You're the next contestant on the Price is Precise. Well, Donna, let's start with you because you clearly haven't read the story like Kristina.
I haven't read the story. Not the Price is
I'm not going to say
The Price is Right.
No, we played Price is.
Okay.
Price is Precise. We're a little afraid of Bob Barker.
Is it even possible that there aren't a lot of these phones out there?
Well, you got one right there. That looks like an iPhone 1.
That's what I was going to ask you. Don't throw that one away. Well, it's funny because you trade them in. I've traded so many in for the next model that who knows. But this was unopened in the box, which if you're a collector nerd, it's always got to be in the box and unopened. Mm-hmm. Like who buys things and then leaves them in the box unopened. But such is life. Someone realized, I guess, that this thing was going to be worth money someday. So
and they saved it.
Yeah.
Smart.
So what do you think? What do you think? And mind you, this is only 2007, a mass-produced device.
Mass-produced.
We're not talking about a Van Gogh here.
Right. I'll go with $15,000.
$15,000. Kristina Hooper, what's your prices precise guess?
So I read the article, but I don't remember the number. I want to say it was 50,000, but it could have been 250.
Yeah, $39,000.
Did I win?
You're kind of right in the middle there.
What?
You have to do the math there. So,
she said, it could have been 250.
I don't want to insult our guest, but I think you won. Yeah, because I think in
won.
Price is Right, you can't go over.
Yeah, you have to go under.
Yeah,
there's actually a documentary on one of the winningest people on Price is Right on Netflix, in case anyone's interested.
How much? Well, on Price is Right, you win like $50 a time. They've won all of like $300 probably.
It's more of a social thing. They get to be like this tight-knit group. They're all standing outside in line to get on the show.
My sister did it once. I just remembered my sister was on the show once.
There you go.
Did she?
Not very long ago, like 2 years ago. She won a bunch of stuff.
Did she win a new car?
No, I wish. Oh my God. New car. No, it wasn't a car.
Washer and dryer?
She won random things.
It must be much harder now, what with inflation. You know, prices are changing so quickly.
Oh, that's a good point. I wonder if it's, there's causing volatility in the prices right, probably.
They have inflation adjusted prices right now.
That's good.
That's kind of the theme of the whole markets this year. The prices are not right. So, all right. Well, Valdana, we'll get your sister on sometime to play the Price is Precise with us.
I guess she's good at it. I don't know. Yeah, she'd probably be better than I am at Price is Precise.
Right. Well, I think that is all our time. Kristina Hooper, it's always such a treat to catch up with you and hear your thinking. You explain the dynamics of the market so eloquently and clearly, and we really appreciate you spending some time with us and doing so.
Thank you so much for having me.
Thank you.
What Goes Up will be back next week. Until then, you can find us on the Bloomberg Terminal, website, and app, or wherever you get your podcasts. We'd love it if you took the time to rate and review the show on Apple Podcasts so more listeners can find us. And you can find us on Twitter. Follow me at Reganonymous. Valdana Heinrich is at Valdana Heinrich. You can also follow Bloomberg Podcasts at Podcasts. What Goes Up is produced by Stacey Wong. Thanks for listening. See you next time.